Vertex Pharmaceuticals heads into 2026 with a genuinely different story than it had just 6 months ago, and it's worth understanding exactly what changed. Back in August 2025, the big question was whether CF cash flows were enough on their own. Today, the debate has moved on to whether Vertex can actually execute outside of CF. That execution story now runs through 3 pillars: Casgevy in gene editing, Jornavex in pain, and a renal pipeline led by povetacicept, each of which has moved from early promise to real, measurable progress. Here's the interesting tension. Despite a quiet 2025 for the share price, Vertex still holds a premium profile among large-cap biotech peers. This is an expectations reset, not a business in trouble. To understand where Vertex stands today, it helps to go back to August 2025 and the specific concerns that defined the investment debate at the time. 3 pressure points stood out then: underwriting CF cash flows well into the 2030s via Alyftrek, proving Jornavex could reach beyond acute pain into diabetic neuropathy, and showing that Casgevy could actually scale through manufacturing and patient throughput. Fast forward to January 2026, and Vertex took the stage at the J.P. Morgan Healthcare Conference with a clear message. Not new narratives, but sharper execution expectations. JPM 2026 pointed investors toward 4 concrete priorities: keeping CF as a long-duration cash engine, improving Casgevy patient throughput, expanding Jornavex prescribing with a doubled field force, and pushing povetacicept toward accelerated approval in the first half of 2026. The arc here is straightforward. Launches that started as promises are now delivering measurable results. And the next question is whether that delivery is enough to re-rate the stock. Let's dig into the CF franchise itself, because the story there is really about an internal product shift, not market decline and not competitive pressure. Alyftrek is ramping toward blockbuster scale in 2026 to 2027, while Trikafta gradually fades. But this isn't Vertex losing ground. It's patients switching to a more convenient, once-daily therapy with similar or better efficacy. Older therapies like Orkambi, Kalydeco, and Symdeko are declining sharply, but they're already a small slice of the mix, so their drop barely dents total CF revenue. This is planned obsolescence, not erosion. Add it all up, and CF revenues run roughly flat to modestly higher through 2028, growing in the mid-single digits, with cash flow staying large, predictable, and high margin, more than enough to fund new launches without straining the business. CF's role has simply changed. It's no longer the growth engine, it's the foundation. Durable, high margin, and reliable, freeing Casgevy, Jornavex, and renal to carry the case for multiple expansion. Now let's look at those 2 new revenue streams, Casgevy and Jornavex, and what it actually takes to get from early-stage launch to blockbuster scale. With Casgevy, demand isn't the problem. The bottleneck is operational, moving patients efficiently from referral through cell collection to infusion, with conditioning capacity and logistics still acting as gating factors. Jornavex follows a clear sequence. Year 1 was about locking in hospital access and payer coverage across all 3 national PBMs. And the next phase is converting that footprint into routine prescribing and reimbursed revenue backed by real-world evidence. With revenue growth settling into the high single-digit range, the question that really matters for Vertex's investment case in 2026 and 2027 is margin recovery. 3 forces are expected to drive that margin inflection. CF stays structurally high margin. Casgevy's heavy upfront infrastructure costs are largely behind it, so new patients cost far less to serve. And Jornavex's gross-to-net headwinds ease as payer coverage stabilizes. In 2027, adjusted EPS growth is modeled to accelerate into the high teens, outpacing revenue growth as launch losses narrow, SG&A levels off, and gross margin recovery flows through to the bottom line. That EPS reacceleration is the key link to multiple expansion. If it plays out, Vertex shifts from a CF cash flow story to a compounder with visible operating leverage. The third piece of the framework asks whether near-term clinical and regulatory milestones can reduce enough uncertainty to re-rate Vertex's growth multiple before revenues fully arrive. Povetacicept in IgA nephropathy is the most consequential asset here. Breakthrough therapy designation, a rolling BLA, and a priority review voucher all compress timelines, with consensus expecting first revenues in 2027 and a steep ramp if accelerated approval lands in 2026. Journavex has proven itself in acute pain, but the real gate is chronic pain, specifically diabetic peripheral neuropathy, where positive Phase 3 data would validate NaV 1.8 inhibition as a platform, while weak data would cap pain's long-term upside. Investors will essentially score Vertex on 3 questions: a clean renal win, clinical proof in chronic pain, and pipeline progress without runaway costs. And 2 out of 3 is likely enough to drive a re-rating. After a subdued 2025, Vertex's valuation multiples have reset to historical midpoints, and that normalization is actually good news. It means fundamentals matter again. Across PE, EV/EBITDA, EV/EBIT, and EV revenue, Vertex now sits near the midpoint of its 5-year range. Still at a premium to large-cap biotech peers, but comfortably within 1 standard deviation of historical averages, reflecting reset expectations rather than a weaker business. At these midpoint multiples, each positive development carries more weight. Revenue is steady. Margin recovery is expected, but not yet peak, and pipeline success is only partially priced in, so incremental execution has a clearer path to moving the stock. The risks are real, though. Slower Casgevy throughput, Journavex stalling beyond early adopters, a renal setback, or margins failing to recover could all keep Vertex range-bound, even with strong science and cash generation. The setup, then, is clean. CF quietly generates durable cash in the background, while the next 12 to 24 months decide whether Vertex's diversification becomes visible enough to re-rate it from a single franchise compounder into a true multi-pillar growth platform.